Wall Street doesn't bet. They engineer wins. While retail investors are crossing fingers, big banks are out here playing 4D chess with loaded dice. Ever heard of leverage? Structured products? Options? Yeah, these aren't just buzzwords. They're the weapons that built billion-dollar empires, and nuked a few too. Stick around, because by the end of this video, you'll see how Wall Street's tools are often just financial grenades wrapped in silk. First, let's talk about the power of leverage, a word that sounds like it belongs in a gym, but on Wall Street, it's steroids for your portfolio. It's using someone else's money to try to make more money. Imagine you've got $1 million. You borrow $9 million more. Boom, you're playing with $10 million. If the market goes your way, you're a genius. If not, well, you're the reason bankers get stress ulcers. That's the magic of leverage. Let's rewind to the 90s. Long-term capital management, run by Nobel Prize winners no less. They were using leverage like it was candy at a hedge fund Halloween party. Worked great, until it didn't. When a financial shock hit, they couldn't cover their losses. The whole thing started to crumble. It got so bad that the Federal Reserve had to step in with a $3.6 billion bailout just to stop it from taking down the entire system. That's not just a bad trade. That's a full-blown meltdown. Flash forward to 2021, Archegos Capital. You might have heard the name. It was run by Bill Hwang, a guy who once worked for a legend on Wall Street. Archegos wasn't a giant hedge fund in the traditional sense, but it was using insane levels of leverage behind the scenes. Through these things called total return swaps, which are basically contracts that let you bet big without revealing what you're actually holding, Archegos was able to take on massive positions without drawing attention. At its peak, it was leveraged 20-to-1. That means for every dollar they actually had, they were controlling $20 worth of stock. Imagine putting down just 5 cents and acting like you own a whole dollar's worth of stuff. That's how exposed they were. And for a while, it worked. Stocks like Viacom-CBS and Baidu were going up, and Archegos was riding high. But then the market turned. Prices dropped. Suddenly, the banks that lent them money came knocking. Hey, we need more collateral. That's called a margin call. But Archegos didn't have enough cash to cover it, so the banks started selling off the stocks themselves. Fast. It was a fire sale. And the damage? Brutal. Credit Suisse lost $5.5 billion. Nomura, $2.8 billion. Morgan Stanley, too. Altogether, the total losses from this single blow-up were over $10 billion. All because of leverage. So yeah, leverage can make you rich faster than you ever imagined, but it can also wipe you out in a heartbeat. It's like driving a Ferrari at 200 miles per hour. Thrilling when the road is clear, deadly when there's a sudden turn. Next up, options. You see, options are like a secret weapon in finance, but one that can turn on you fast if you don't know what you're doing. Options give you the right, not the obligation, to buy or sell a stock at a certain price. It's like reserving a front row ticket to a concert. If the band sucks, you just don't go. Buy a call? You're betting the stock goes up. If it does, boom, you pocket the difference, minus the small fee you paid for the option, which is called the premium. A put option works the other way. It gives you the right to sell a stock at a set price, which is super useful if you think the stock is going to tank. Now here's where it gets wild. For just a few bucks in premium, you can control 100 shares of stock. So even if you don't have $30,000 to buy 100 shares of Tesla outright, you might only need $300 to buy an option contract. That's leverage, using a little bit of money to potentially make a whole lot more. And that's exactly what happened in 2020 with Reddit's WallStreetBets crowd. Retail traders piled into Tesla call options, betting that the stock would keep rising, and it did, for a while. Some traders turned a few $100 into tens of thousands in days. The gains were explosive, but when the market cooled off or started moving sideways, those same options started bleeding value fast. That premium they paid? Gone. Because if the stock doesn't hit the strike price before the expiration date, the option becomes worthless. That's the double-edged sword of options. They offer what traders call asymmetric risk. You can only lose what you paid for the option, your premium, but the upside can be huge. It's like betting on a horse race where you can only lose your ticket price, but if your horse wins, you cash out big. But remember, most options expire worthless. They seem simple, but they're built on complex math, probabilities, and timing. So while they look like easy wins, especially during hype-fueled rallies, they can just as easily burn a hole in your wallet if you don't know what you're doing. Finally, structured products. Structured products are kind of like a custom-built financial smoothie. They mix together different ingredients, usually things like bonds, options, and other derivatives, to create a single investment product tailored to deliver a specific outcome. It's like using financial Lego blocks. You combine the right pieces depending on what you want. Maybe a little safety, a little growth, and some exposure to a particular index like the S&P 500. Let's say you're a cautious investor. A bank might offer you a structured note that promises to protect your principal as long as you hold it to maturity. But if the S&P 500 goes up by a certain amount during that time, you also get a bonus return. Sounds like a win-win, right? You don't lose your initial investment, and you might earn more if the market does well. That's the pitch. But here's what they don't always tell you up front. Structured products are usually created and sold by big banks, and they're not always made with your best interest in mind. Many of them are incredibly complex and tough to understand, even for experienced investors. The terms are buried in pages of legal language, and while they often come with flashy promises, principal protection, or enhanced returns, the devil is in the details. Take the 2008 financial crisis, for example. Lehman Brothers sold billions of dollars worth of structured notes to everyday investors. These products were rated AAA, which is basically the gold standard for safety. But when Lehman collapsed, those notes became worthless overnight. People lost their life savings in investments they thought were low risk. The products were so complex and poorly understood that most investors didn't even realize how much risk they were actually taking. Even today, structured products can carry hidden dangers. They often include layers of fees that eat into your returns. Some use leverage, which can amplify both gains and losses. They're also subject to credit risk, meaning if the issuer goes bust, your money might vanish with it. And liquidity? That's another problem. These aren't like stocks where you can just sell and walk away. Structured products are often tough to value, and even harder to exit before maturity without taking a loss. In short, they might look neat on the outside, neatly packaged, tailored to your risk appetite. But inside, they can be full of landmines. What makes them attractive to banks is exactly what makes them dangerous to the average investor: complexity, opacity, and the illusion of safety. So, why Wall Street loves the tricks? Big firms are obsessed with complexity. And for good reason, it pays. When they use leverage, options, or structured products, they can fine-tune risk, target specific outcomes, and rake in massive fees along the way. Hedge funds, for example, love leverage because it lets them juice up their returns. A 5% move in the market can turn into 50% gains if you're playing with borrowed money. And banks? They cook up exotic structured notes, often with glossy brochures and slick sales pitches, and sell them to high-net-worth individuals who want something customized. Everyone wants an edge, something personalized. But more often than not, the risk baked into these products is either misunderstood or completely invisible until it's too late. It's kind of like watching a magic trick. At first, it's exciting, the numbers look great, you feel in control. But once something goes off script, even slightly, the illusion collapses. Just look at Archegos Capital. It was a private investment firm using insane levels of leverage through complex swaps and derivatives. On paper, it looked genius, until one wrong move triggered margin calls and the whole house of cards fell. In the end, banks like Credit Suisse and Nomura lost billions. Not investors, Banks. That's how deeply intertwined and dangerous these strategies can be. Go back a few decades to long-term capital management, LTCM. This was a hedge fund run by literal Nobel Prize winners. They used complex math, derivatives, and massive leverage to squeeze out profits, and for a while, it worked beautifully. Until Russia defaulted on its debt in 1998. That one shock sent LTCM spiraling and brought the entire financial system to the brink. It was so bad the Federal Reserve had to step in and coordinate a bailout, not for a country, but for a hedge fund. And then there's the retail investor side of things. Folks who aren't managing billions, but still got caught in the web. Leading up to 2008, many regular people bought structured notes from banks. These were pitched as safe investments with a twist. You'll get your money back, and if the market performs well, you get a bonus. What they weren't told was how fragile these notes actually were. When Lehman Brothers collapsed, thousands of retail investors found their safe structured products were worthless. Why? Because the issuer, Lehman, was the one guaranteeing the safety. Leverage makes everything look better in the beginning. You're doubling or tripling your money faster. Options give you a rush because a good bet can pay out huge in days. But the expiration clock is always ticking. And structured products promise the world. But the fine print almost never leans in your favor. The moment the market shifts in an unexpected way, those same tools that seemed like a shortcut to wealth become a straight drop into losses. So yeah, complexity in finance isn't always about innovation. It's often just a more complicated way to shift risk, collect fees, and keep the odds tilted in favor of the house. Tools like leverage, options, and structured products aren't evil. They're powerful. In the hands of skilled traders, they can make billions. In the hands of markets, they can wipe out stability. If you're investing, know what you're holding. Understand the leverage, the derivatives, and the hidden triggers. Because while Wall Street engineers wins, it also engineers disasters. Thanks for watching. Hit like if this opened your eyes, and subscribe for more real breakdowns on finance's inner game.